There's a profound paradox at the very core of investing. A truth that eludes most of us as we navigate the complex world of finance. We find ourselves consumed with studying stock charts, meticulously dissecting financial reports, and obsessively monitoring news feeds. All in the hopes that the market gods will bestow favor upon our investment portfolios. We often perceive the market as an adversarial force, a raging bull that demands taming and control. All our anxieties, fears, and uncertainties are projected outward onto this external entity. Is a devastating market crash on the horizon, waiting to wipe out our hard-earned savings? Will this seemingly promising stock suddenly plummet into oblivion, leaving us with substantial losses? What if interest rates skyrocket unexpectedly, disrupting the entire financial landscape? But what if we dared to shift our perspective, even for a single day? What if we could momentarily detach ourselves from these external pressures and redirect our focus inward? I encourage you to try something radically different today. Instead of obsessing over macroeconomic indicators and geopolitical events, turn your attention to the person holding the device, clicking the mouse, and making the investment decisions, yourself. Because ultimately, after all the data crunching, sophisticated algorithms, and expert analysis, the greatest threat to your financial success, the one factor that can sabotage even the most meticulously crafted investment strategy, resides within the confines of your own mind. It's the intricate interplay between your own brain and heart. That's right. An investor's most formidable enemy isn't an impending recession, sensational negative headlines, or even a large-scale corporate scandal that rocks the financial world. It's the internal battles we wage against ourselves, the crippling fear of potential loss, the insatiable desire for excessive gain, the ego that constantly seeks validation, and the impatience that demands instant gratification. These emotional forces, if left unchecked, can lead to disastrous investment decisions. Let me introduce you to Mark. A prime example of how these internal enemies can wreak havoc on an investor's journey. He enthusiastically entered the investing world back in 2017. A time when the market was experiencing a seemingly endless bull run. Everything was sunshine and rainbows. And his portfolio was consistently awash in green, indicating substantial gains. He felt like a financial genius. A prodigy who had been hiding in plain sight, suddenly discovering his exceptional talent for picking winning stocks. He couldn't resist sharing his investment triumphs at every social gathering, eagerly regaling friends and acquaintances with his carefully selected stock picks and boasting about his burgeoning wealth. Then came the harsh awakening of the fourth quarter of 2018. A period that would forever change his perspective on the market. The market experienced a sharp and unexpected downturn, sending shockwaves through the financial world. His stocks, the very companies he had previously held such unwavering faith in, plummeted in value by 20, even 30%, in a matter of weeks. Initially, he tried to maintain a brave face, convincing himself that this was merely a temporary setback and that the market would inevitably rebound. But each time he opened his trading app and saw that sea of red, representing significant losses, a sickening feeling gnawed at him, eroding his confidence and fueling his anxiety. His phone started ringing incessantly. Friends, seemingly well-meaning but ultimately adding to his stress, urged him to cut his losses and exit the market before things got even worse. Sell, Mark. Get out while you still can. You're going to lose everything. The media relentlessly hammered home the anxiety surrounding escalating trade wars, painting a bleak picture of the future and further exacerbating Mark's fears. Then one fateful morning, fueled by sheer panic and desperation, he made a rash decision. He liquidated his entire portfolio, selling off all his stocks at a significant loss. He escaped the market crash, but not before incurring a painful 25% loss on his initial investment. He let out a sigh of relief. momentarily freed from the psychological torment that had been consuming him. Even though his bank account had taken a significant hit, he felt a sense of liberation, believing that the worst was finally over. And you know what happened next, right? Just a few months later, the market staged a remarkable comeback, swiftly erasing all those previous losses and then some. The stocks he had so hastily dumped, the very companies he had lost faith in, doubled, even tripled in value in the years that followed, leaving him with a deep sense of regret and missed opportunity. Mark didn't lose money because of the inherent volatility of the market or the unpredictable nature of economic cycles. He lost because of the paralyzing fear that consumed him, clouding his judgment and leading him to make irrational decisions. The real enemy wasn't the fluctuating stock chart. It was that overwhelming feeling of utter panic that drove him to abandon his long-term investment strategy. This is the first and perhaps most potent enemy we must confront in our journey as investors: the fear of loss. Scientific studies have consistently demonstrated that the emotional pain of losing a certain amount of money, say, $10,000, is twice as intense as the joy of gaining an equivalent amount. In the realm of investing, this psychological bias can be a recipe for disaster, compelling us to make rash and ill-advised decisions. It drives us to sell in a frenzy during market downturns to avoid immediate pain, and in the process, miss out on substantial long-term gains that would have more than compensated for the initial losses. It also leads us to cling desperately to underperforming stocks, stubbornly hoping for a miraculous turnaround that rarely materializes. Instead of acknowledging our mistakes, cutting our losses, and seizing new opportunities, we become paralyzed by fear, driven solely by the desire to avoid further pain. Rational decision-making goes out the window, replaced by emotional reactions. But fear is only one side of the coin. The other side is even more treacherous, precisely because it often masquerades as opportunity and excitement. This is the second enemy: greed and the ever-present FOMO, the fear of missing out. Have you ever witnessed a stock skyrocket by 50% in a single week, seemingly defying all logic and reason, and then berated yourself with the thought, "Why didn't I buy in when I had the chance?" And then, spurred by that regret and a desperate desire to not miss out on further gains, you jump in at the absolute peak, blindly hoping it will continue to climb even higher. But typically, you're buying when everyone else is cashing out. The smart money ready and waiting to offload their holdings onto you at the first sign of a market correction. FOMO makes us abandon our carefully laid plans, our well-defined investment criteria, and our rational risk assessments to chase after the next big thing, without truly understanding the underlying fundamentals of what we're buying. We're no longer investing. We're gambling, hoping for a quick buck and succumbing to the allure of instant riches. Greed whispers insidious promises in our ears: just a little bit more. Let it run a bit longer. You can get even richer. And we foolishly ignore prudent risk management principles, failing to take profits when we should, watching helplessly as those paper gains evaporate before our very eyes, leaving us with nothing but regret. Then comes the third enemy, perhaps the most subtle and therefore the most difficult to identify and overcome: your own ego. We start to intertwine our sense of self-worth, our personal identity, with our investment choices. Buying a stock ceases to be a simple financial transaction; it transforms into a personal statement, a reflection of our perceived intelligence and abilities. Asterisk, I am smart because I picked this stock. Asterisk, I have vision, unlike those other clueless investors. Asterisk, I am right. And the market will eventually recognize my genius. And once the ego gets involved, admitting mistakes becomes nearly impossible. A direct threat to our carefully constructed self-image. Acknowledging that a particular stock is a bad investment is akin to admitting that we ourselves are flawed, that we are not as intelligent or insightful as we thought we were. So, we grasp at any rationalization, cling to our losing positions, and stubbornly refuse to confront the harsh reality of our situation. We scour online forums and social media for comments that validate our choices, selectively ignoring any dissenting voices or critical analyses that challenge our beliefs. This ego also manifests in our insatiable desire to outperform the market, to achieve returns that far exceed the average investor. We're not content with a respectable 10 to 12% return from a diversified index fund, a benchmark that represents the overall performance of the market. We crave more, driven by the need to prove that we're smarter, more skilled, and more capable than the average investor. And that futile comparison, that relentless competition, leads us to take on unnecessary risks, jeopardizing our long-term financial well-being in the pursuit of short-term gains and ego gratification. So, how do you effectively combat these insidious internal enemies that threaten to derail your investment success? You can't eradicate them completely. They're intrinsic to human nature, deeply ingrained in our psychological makeup. But you can develop a robust defense system, a well-defined mental framework designed to mitigate their influence and prevent them from controlling your decisions. I call it building a mental position as solid and well-fortified as a diversified position in your investment portfolio. The first pillar of your mental position is to meticulously document your investment plan before emotions take over and cloud your judgment. This detailed plan is your most potent weapon against irrationality, serving as a guide to navigate turbulent market conditions. A plan isn't simply a vague statement like, "I will buy stock ABC." A plan is a comprehensive set of instructions for your future self, for those moments when you're grappling with fear, blinded by greed, or swayed by the allure of FOMO. It must address crucial questions. How long do I realistically expect to hold this investment, barring unforeseen circumstances? What specific circumstances would trigger a sell, regardless of my emotional attachment to the stock? What is the maximum loss I am willing to tolerate on this investment before cutting my losses? When will I take partial profits to secure my gains and protect my downside risk? When you have this plan clearly articulated on paper, created in a moment of clear-headedness and rational thinking, you've effectively delegated a task to your rational self, entrusting it to guide you through challenging times. When the market inevitably fluctuates and emotions surge, you don't need to rely on instinct or gut feelings. You simply consult your written plan and adhere strictly to its guidelines. You've effectively separated the decision-making process from the volatile grip of emotion. The second pillar is to prioritize the investment system over short-term results and fleeting market trends. Think of a professional basketball player striving for excellence. He can't guarantee that every shot he takes will go in, but he can control his system, practicing 500 shots daily, maintaining a healthy diet, ensuring adequate sleep, and consistently refining his skills. With a disciplined system in place, success rates will naturally follow as a byproduct of consistent effort and dedication. Investing is analogous. What's your system for achieving your financial goals? It might involve consistently allocating a predetermined amount of capital each month, automatically purchasing a high-quality, diversified asset like a broad market ETF, exchange-traded fund, and steadfastly adhering to this strategy regardless of the latest news headlines or market fluctuations. If you have unwavering faith in your system, grounded in solid research and sound financial principles, then a 3% market decline isn't a cause for alarm or impulsive action. It's simply another day within the system, a temporary setback that doesn't invalidate your long-term strategy. It's like a rainy day for the dedicated basketball player. He still shows up to practice, knowing that consistency is key to achieving his goals. Judge your progress based on your adherence to the system, not on the daily fluctuations of your account balance, which are often driven by factors beyond your control. The third pillar is to schedule regular self-check-ins. Dedicating time for introspective reflection and honest self-assessment. Every quarter. Set aside 30 minutes not to obsess over profit and loss statements or scrutinize market performance, but to engage in introspective questioning, examining your own behavior and identifying potential biases. Asterisk, have I recently made any investment decisions driven by emotions like fear, greed, or pride? Asterisk, am I faithfully adhering to my written investment plan? Or have I deviated from it in response to market pressures? Asterisk, am I comparing my performance to that of others, allowing their success or failure to influence my own decisions? This regular self-assessment serves as a powerful antidote to ego and impatience, returning you to the driver's seat of your investment strategy and ensuring that you remain grounded in rational decision-making. Finally, remember this fundamental truth that underpins all successful investing: the market is a colossal machine, reflecting the collective information, expectations, and emotions of millions of participants from around the globe. You cannot control it, predict its every move, or bend it to your will. But you can control the one thing that truly matters: your reaction to it. When negative news breaks, casting a shadow of uncertainty over the financial landscape, what is your immediate response? Do you instinctively open your trading app and start selling off your assets in a panic? Or do you calmly review your investment plan, reaffirm your original rationale for investing in those particular assets, and assess whether the new information fundamentally alters your long-term outlook? When you observe others profiting handsomely from a particular asset class or investment strategy, do you impulsively jump in without conducting thorough research? Or do you meticulously assess whether it aligns with your established system and investment criteria? Victory in investing isn't about flawlessly predicting every market peak and trough, mastering complex trading techniques, or accumulating vast amounts of inside information. It's about not sabotaging yourself, recognizing the true enemy lurking within your own mind, and constructing a mental fortress strong enough to withstand its insidious influence. Today, immediately after finishing this reading, I want you to take a simple but powerful step that can significantly improve your investment decision-making. Grab a piece of paper and write the title, Mental Rule Book 4, your name, the investor. Beneath it, list the 2 or 3 most prominent emotions that typically lead you to make poor investment decisions. Emotions that have historically caused you to deviate from your rational plan. For each emotion, define a specific, actionable step you will take when it arises, a concrete response designed to counter its negative influence. Let that paper serve as the commander of your rational self, a constant reminder of your commitment to disciplined investing. Because when the emotional storm inevitably hits, you won't be fighting alone, you'll have a well-defined plan to guide you. A mental strategy to weather the turbulence and emerge stronger on the other side. If you want to delve deeper into building a practical, step-by-step investment system to support this resilient mindset, check out our previous guide on how to start investing without panic selling. The link is here and on the screen. And if you want me to analyze other psychological traps that commonly ensnare investors, such as confirmation bias or the illusion of control, let me know in the comments and hit subscribe. Remember, the market will always be a volatile landscape, filled with uncertainty and unexpected events. But those who conquer the enemy within, those who master their emotions and cultivate a disciplined mindset, will always find a way to navigate any storm and achieve their long-term financial goals. Stay disciplined, stay focused, and stay true to your plan. I'll see you in the next video.